Hello again. The last time I spoke to Ranjeet Sandhu from London Stone Securities, he told me he was sceptical about the January bull run, but with the FTSE pushing higher, has he changed his mind? The last time we spoke, you were sceptical about this January bull run, but now the FTSE is approaching 6,200. It just keeps on continuing.
It does, and I think the confidence is still misplaced. Technically we're at an RSI of 90. We haven't breached the 6250 mark, which is a critical resistance level. And I genuinely feel a lot of investors are in for a rude awakening. I feel this market is probably overvalued by at least 200 points. The January effect takes place pretty much year in, year out, so there's no surprise that we are up here. But I do think you'll find that once one or two investors, big investors, start to sell, you may well get a mass exodus out of the markets, and I think you'll start seeing panic kick in probably in the first 2 weeks of February.
So if you're expecting the market to fall, how are you positioning yourself?
It's a good question. We are, at London Stone, we adopt a number of strategies. The first one is an obvious one, which a number of investors don't actually employ often enough, is simply cashing in their portfolio. So simply getting rid of the high beta stocks, getting rid of the volatile mining, banking stocks, and going into defensive utility companies. An alternative to that, if you don't want to sell those stocks, is simply to use derivatives. So you can either write some call options, you can sell some puts, you can possibly do a short CFD position, or you can even do a straddle or a strangle. Now, I know a lot of clients will look at derivatives and think it's high risk, but in actual fact, derivatives were initially utilised to reduce the risk. So we would implement derivatives as part of a hedging tool. And the third thing I would expect you to do is to actually change your investment strategy. So whereas in the past you're looking for momentum trades, I think now is a good time to be looking for value trades. So wait for the market to drop and then par back in, probably 300 points, 400 points lower than where we are now. Also, last time we spoke, you were looking at an Egyptian gold company. Anything catching your eye now? I like, Sentiment Egypt is a company that you're referring to. I mean, Sentiment Egypt is still undervalued. They're up another 3%, I think, from my last interview, which was from last week. The company that I personally hold myself is a company called Man Group Financial, EMG. I think it's the second or third largest hedge fund in the world. The reason I like that is because last year they were £2 a share, went down to 70p. They had quite a large number of funds leaving them for a number of reasons. Those problems look as though they've been resolved. They pay a dividend of 12%, and they've just broken through the 200-day moving average. So I think you buy them now at 90p. Short term to medium term is probably 110, longer term is 150. The numbers stack up. You're looking at 40 to 50% capital appreciation, and all the while you're still getting 11 or 12% as an income.
Yeah, and you said that the banking sector and mining sector are particularly volatile. Are those sectors which you totally avoid in this situation?
For the short term, I think the banking sector will continue its run. I think the banking sector will really start to suffer once the problems with Europe rear its ugly head again, and I imagine that will probably happen in the second half of this year. So you're probably looking at Greece, Spain and Italy having deficit problems again, looking for further bailouts. I think the banking sector, insurance companies will suffer then. The one sector we're avoiding, in addition to the banking sector further down the road, but we're avoiding now, is the retail sector. I think the retail sector is struggling. I mean, last week Jessops and HMV have pretty much gone bust. Woolworths, obviously a couple of years ago. Mothercare is struggling. And I think the street shopping, pedestrian type traffic has dried up, and I think people like Amazon and companies like Amazon are really taking over. The one good thing to say is there are some companies like Argos which actually have a good high street retail presence, but also have a good online facility as well. But I think a lot of companies have neglected, not just now, but last 5 or 10 years, the importance of the internet, and I think they're suffering now.
Yeah, and just to finish off, obviously there's been big news from the UK over the last day or so, with David Cameron announcing there could be a referendum in 2017 in relation to the EU membership. Does that impact your investment strategy?
For the long term, it possibly will. I think for the short term, it's minimal. The market's very volatile. Short term plays are far more important. The referendum, I think, is a good thing. I think in the short term it's going to have very little impact. I think people are really looking at inflation, unemployment and growth. But I think certainly in the long-term 5 to 10 year portfolio analysis that we sometimes look at, they may have some limited impact.
Well, Ranjeet Sandhu speaking to me there. We still have interviews to come with Gecko Global Markets and Nutmeg on London Direct, so stay tuned for those. Goodbye for now.